All right, and we are live. So, thank you everybody for attending. Today, we're going to be taking a deep dive into the ITC 48, 48E, refundable energy tax credits. There are a few names that go along with this, and we'll sort some of that out today. But for a little bit of housekeeping, if you guys have any questions, we will post them in the chat. We'll try to answer them promptly. But we also have a few minutes left over at the end of our webinar, and that's dedicated just to answering your questions. So definitely excited to get started today, and yeah, let's get right into it. So who is Leyton, and why should you listen to us, right? So Leyton has been around for 25 years. We're an international tax consulting firm. Our specialty globally is R&D. We are the leading provider for research and development tax credit globally. But we have offices in 16 countries, USA being one of those 16. And we have different energy incentives, real estate development, R&D, salts. We'll go over kind of what we offer towards the last part of the program, but we are consultants and we specialize in some niche incentives that CPAs typically can't do, but we love CPAs. We love working with them. And that's kind of our bread and butter, is working with the CPA to make sure that the benefit is a benefit. So today you're going to be hearing from myself. I will be playing host, and Andrew Nlemadim will be playing, well, he will not be playing. He is the subject matter expert in this field. Myself, I've been in the industry for about 10 years. I'm a senior project manager here at Leyton, one of the directors here at our commercial real estate business unit. And my background is mainly in 179D and cost segregation. I'm also very dangerous with 45L and ITC as well. But I'm also a father of three. And so if, there's a lot of heavy material that we're going to cover today. And so if any dad jokes make it into this material to try to lighten it up, please forgive me ahead of time. But I'll let Andrew kind of discuss or give you a brief overview of who he is.
Thank you, Cedric, and good afternoon, everyone. My name is Andrew Nlemadim. I'm an engineer by background, but I've been in the specialty tax industry for a bit short of a decade now. Mainly, my experience spans R&D tax credits, the energy efficient commercial building incentives, as well as of 2022, the Inflation Reduction Act. So I spend a bulk of my time helping nonprofit and for-profit business owners take advantage of these incentives. To date, have done probably somewhere north of 300 energy studies and have delivered over $100 million in various tax incentives. So in my free time as well, I'm either being a dad to my daughter, as well as playing pickleball if I'm not reading some tax law. So excited to present 48 and 48E to you all today.
Pickleball, fatherhood, and tax. Let's go. Let's get into it. Okay, so what are we going to be covering today, right? We're going to be going over the basics of what ITC is, so basic tax incentive overview. We're going to be diving into what qualifies as either the property basis or what is a qualified project, the differences between 48E and 48, some of the technology differences, and then kind of some pitfalls that we see a lot of tax-exempt entities falling into. So we'll go over those towards the end, and also some best practices as well. So let's get started with kind of an overview of the incentives here. I'm sorry about that. So Andrew, what's the difference? What's 48? What's 48E? Seems like with the one has a capital E and one doesn't, but is there more to it than that?
Right. Yes. They almost pretty much look the same, but I'll give it a little bit of a foundation. So the ITC has actually been around since like the 1960s. And although it has evolved over time, the intent and the base has essentially been the same. Congress has always used it as a way for economic development to encourage investment and energy interdependence. So if you can imagine back in the 60s or 70s, advanced coal power plants were on that list. And we see with the Energy Policy Act of '05, we see solar start to make a name on that list. And it's always essentially been a prescriptive specific technology that is on that list, and you're able to get a tax credit anywhere ranging from 10 to 70%, depending on the specific system. Now, the Inflation Reduction Act expanded this section as well as added another code section called 48E, and this one was essentially made to be a bit future-proof. So there are some different requirements, but it was essentially to lay the foundation for the clean energy future. And we'll talk about that in these next slides.
Yeah, it's a great segue into the next slide here, because what we're going to see next are the actual technologies that are 48. And so it's a good contrast. Andrew, these are the technologies that are eligible for Section 48. Which ones are the most popular? Like, which ones do we see most often in our practice?
Great question. So solar is going to take the cake as far as frequency. That's going to be for-profit, for nonprofit. We see that a lot with school districts as well adopting that technology. To name a couple of others, geothermal heat pumps is something that I'm seeing a lot within capital improvement plans for school districts pre-IRA, but now with the IRA expanding to be able to get 40 or 50% back, that has become mostly popular. And I think a couple of, I would say, sleeper systems here that are on the list are going to be combined heat and power. So what we typically see like in campuses are cogeneration systems, and they've been around for decades and serving larger campuses with more than maybe 4 or 5 buildings in a centralized way. That would actually qualify start for properties that are placed in service after 2023. And then also under the energy storage category, thermal energy storage. So that is, if it is an ice energy storage system that's tied to a chiller system cooling a campus or schools, that is something that also would qualify, that often gets overlooked.
Got it. Yeah, I know that those cogen plants are very technically complex. Yes, for sure. And we're seeing a lot of geothermal heat pumps as well. Very popular technology coming into play. So just to contrast, these are what's available in Section 48. And again, let's take a look at Section 48E, just so we can get the basics of the differences down pat before we move on to the next section.
Great. So most technologies for Section 48 sunset for facilities that have not begun construction prior to 2025. So what that means is if you started construction after December 31st of 2024, then your project would likely be at risk under being evaluated under Section 48. So what that means is for, say, combined heat and power systems or microgrid controllers, their qualification may be at risk. However, electricity producing property is kind of moved over to Section 48E. So the requirements for 48E is, 1, you have to produce electricity, and 2, the emission standards have to be 0 or less, and that's CO2 production over electricity production. So things that already are going to make this list are going to be solar, wind, marine and hydrokinetic technology, utility, geothermal, nuclear fission, and nuclear fusion. So just to name a few there, solar is covered under Section 48E for when construction starts after December 31st of 2024.
Got it. All right, let's move on to the next slide here, where we're going to discuss a little bit more about 48E and some of the terminology. Andrew?
Right. So again, the terminology there, 48 is going to apply to those specific prescriptive energy properties that you saw on that list. And 48E is more of a future-proofed, vague but not so vague way of trying to get innovation sparked by having those two requirements. 1, facility needs to produce electricity. Two, greenhouse gas, it has to essentially emit little to no carbon. And then energy storage will also be covered under Section 48. So that's going to be thermal, electric, and hydrogen energy storage.
Yeah, a lot of moving parts. But conceptually, I think if you can leave this webinar with the basic understanding that 48 is all about the technology, whereas 48E is all about, does it produce electricity? And for the most part, it's a good conceptual understanding. But obviously, if you guys are thinking about a project, you'll want to consult a professional. You'll continue to see why. There's a lot of dates, milestones, and things that need to be met in order to claim really 48 or 48E. So yeah, credit utilization. I know this conversation is going to be geared more towards the tax exempt entity, but let's give the folks kind of the full range of who is available, this credit is available for.
Sure. So as of 2023, the Inflation Reduction Act expanded its provision to serve more than just our typical for-profit, tax-efficient business. So what that means is the first way, and the traditional way that you can take advantage of the credit, is direct application to your tax liability, right? That is, I take a credit, that credit amount is then put on my return to offset my current tax liability. Now, in a situation where you might not have that tax liability, the Congress made a provision for you to be able to transfer this tax credit. You can elect to transfer to an unrelated entity and can receive back a dollar amount in cash for that. So another way to expand that energy adoption and to level the playing field for companies that aren't profiting as well as others. And then lastly, which we'll be spending most of our time here, is the elective pay provision, which is the most astounding. It is a way for all tax-exempt entities, whether that be nonprofit, government, tribal entities, to take advantage of the investment tax credit in a rebate structure. So we'll cover the mechanisms in future slides, but this essentially levels the playing field for all entities to adopt clean energy technologies.
All right, so I think the next slide here is going to start getting into a little bit more of the nuts and bolts of what is elective pay. So yeah.
So what is elective pay? Again, the Inflation Reduction Act allowed for tax-exempt entities, government entities, that's even towns and cities, be able to take advantage of these credits by getting a cash refund. What that looks like is you do go through the traditional tax process like a for-profit taxpayer would, by using certain forms, depending on if you file traditionally like a 990 as a nonprofit, or if you don't file, there's the 990T, which is a mechanism for just to reflect this tax credit. It flows from the source credit form to the general business credit. And what it looks like for nonprofits is an overpayment in tax. That allows the IRS the ability to issue a refund. So think about this like a rebate. You're spending on your specific technology, and then sometime in the future, you're getting back a percentage of that money on your qualified spend.
Got it. So correct me if I'm wrong, but I mean, a lot of the tax exempt entities that we come in contact with or we help never filed a tax return, don't really understand the mechanics of it. How important is it to get this right, to talk to somebody that's done it before, make sure that you're hitting the milestones? How important is that?
On a scale of 1 to 10, I would say 10. And maybe that's like asking your barber if you need a haircut. But at the end of the day, there's a lot of registration, or there's a registration that takes place at the beginning of the project after getting placed in service. There is a potential 10 to 20% that we'll discuss. That's based on an application that has a lot of timing involved. And there's some mindfulness when it comes to RFQs and RFPs. Also, if you are trying to opt for domestic content. So having an advisor, I think, along the way from ideation phase all the way from development to eventually getting your system placed in service and reporting, I think is extremely essential.
So I think they call that a slam in pickleball, if I'm not mistaken. So,
Right.
okay, so let's discuss a little bit further about who can receive direct pay.
So these are a list of the eligible organizations, tax exempt entities that are exempt under Section 501, states, local governments. So that's going to be those cities, counties, school districts as well. You have U.S. territories. So Puerto Rico is also included in that. You have Indian tribal government subdivisions, ANCs, Alaska Native Corporations, the Tennessee Valley Authority, and then electric or rural electric cooperatives. And now this is for the elective pay provision, which is that rebate structure I explained earlier. Now, for-profit companies typically cannot opt for this. There is a nuance with another manufacturing or energy manufacturing credit where you're able to get a refund, but generally, this is an incentive that is specifically for nonprofits.
Right.
So,
So yeah, you take this slide away. I think there's some nuances here, so I might ask a few questions, but
so simply, you have to own the eligible property. And although this sounds simple, it's actually a very important step. There has been times where we're scoping to figure out that, hey, this project is actually under a partnership with the for-profit entity, which does make the puzzle a little bit more complex. So just to go over a couple of these rules, that tax exempt entity must own eligible property to be able to take advantage of direct pay. If you have a power purchase agreement, meaning the company or a third party owns the system, you're just renting it, then you cannot take this as well. So again, nonprofit has to be the owner or investor. And I just explained the partnership aspect. So if you are in a partnership with a for-profit entity, that would actually be a credit taken under that traditional method that we talked about earlier. And it's also important to note, sorry, Cedric, back on that slide. It's important to note that Section 48 and 48E are two credits that are within the elective pay suite. However, there is alternative fuel credits. You have new credits dedicated to nuclear power, hydrogen, clean fuel, and electricity production under Section 45. We're just taking this webinar to talk through the Section 48 investment tax credit and 48E. However, there's tons of other tax credits that tax exempt entities can potentially qualify for as well. Okay, so who is eligible? It's going to be, again, the taxpayer that constructs, reconstructs, or erects this property. So if you in a situation where your own GC is sent, you can still qualify for this tax credit. It doesn't need to be a direct purchase from a third party. If you decide to, you can also acquire energy property. So as long as the original use is with you. So it's essentially going to be used in most situations. And what goes into the calculation is going to be, or what we call the eligible basis, that then funnels in the tax credit. Expenses are labor cost, material cost, other expenses like mobilization, rentals, permitting fees are either going to be directly applied or allocable to your project, depending on the nature of it. And in the event that you're acquiring the project, typically the eligible property is that acquisition price. And the type of property that is eligible to go into the basis, it needs to be depreciable property. And it needs to also be a unit of energy property. And what makes up a unit is going to be integral parts, incremental costs, and dual use property. We'll cover that in this next slide here. The last requirement for a project when determining your qualification is going to be when the project is placed in service. This is extremely important, especially given notices like the One Big Beautiful Bill, where we're starting to see a couple of cutoffs or sunsets due to either beginning of construction requirements or place in service requirements. So what constitutes placed in service. It's going to be when you have maybe the necessary permits obtained for something to be available for its permitted purpose or use. You have testing. So when tests are completed, that's a good way to substantiate when something is ready for use. And then also you have COOs, or a certificate of occupancy. That's also a great way to determine, especially in an HVAC project, when your building is essentially ready to go.
All right. Let's talk more about the energy property, and we'll probably ask you to share an example here, but if you want to just give some highlights for the audience, and then we'll see if there's an example we can share.
Perfect. So a unit of energy property is going to be all components that are functionally interdependent, owned by the taxpayer, that operate together and can be or can function independently from another energy property. So I think the best way to describe that is going to be a simple solar system, one where you have solar panels, you have inverters, wires that all need to work together to transmit energy. That's what is functionally interdependent, and that is going to be one unit of energy property, because all the components are installed on the rooftop and they form one single unit of energy property. Now, integral property is property that is used directly in the energy property's intended function and is essential to its completeness. So that means that each and every component of the unit of energy property, since they rely on one another to get the job done, those would be considered properties that are integral. Now, when situations are a bit more complex, like when you have maybe a combined heat and power system or a thermal energy system, these two roles are often going to be key into substantiating what goes in the eligible basis and what is disqualified.
So we run into this question a lot. If we have somebody, a taxpayer or tax-exempt entity, installing solar panels, what about the racks that hold the solar panels? Would that be considered eligible basis or unit of energy property?
That's a great question. So the racks that hold the panels themselves would qualify. Structural equipment that doesn't, for the record, would be a roof. I hear oftentimes a lot of taxpayers as well as nonprofits will say, well, hey, before this solar panel, it's recommended that I get a roof, and it needs to be a new roof. And now there are some other rules, such as the incremental cost rule, where it's extremely important to establish what goes into the energy property basis as qualified and what stays out. So in a case where part of a roof could qualify, if you can imagine, if you have bifacial panels that face the bottom of the roof and obviously the top of the roof, as well as a reflective coating on your roof, this would allow for you to take advantage of more sunlight hours and generate more electricity as rays are bouncing from the roof into the back of the bifacial solar panel. So back end generation. What the IRS through PLRs and other guidance have suggested here is that you need to look at the cost of a regular roof as well as the cost of a reflective roof in order to take that cost difference to add to the basis of energy property. So another simple rule here, just to tell you that these case-by-case circumstances are complex, and it's best to use an advisor when technologies are, ever so evolving, and you need to use regulations and guidance to qualify the basis in which you're claiming a credit on.
Got it. Thanks. We're gonna move along here for the interest of time. We could probably double click on a few of those categories and expand, but for now, let's keep it moving and talk about how the One Big Beautiful Bill has changed this incentive.
Right. So the One Big Beautiful Bill, the biggest change that we're seeing is going to be to solar and wind. If you don't start construction before July 4th of 2026, then your project could be at risk depending on its place in service. So you'll need to place it in service before 2028, or you won't get a credit at all. For systems that start construction prior to this, then you are still going to be on that 2033 to 2035 timeline where you can get a partial credit or a full credit. There was a ban as well to wind and solar leasing. So if you buy this property outright and you lease it to another user for properties that begin construction after July 4th, then you will not be entitled to the tax credit as well. So it has to stay with the owner. There was a boost to fuel cell through Section 48, and they also dropped the emission requirements for it. It's not subject to recapture if it is emitting carbon during electricity production. And a few house cleaning items as well: micro turbines, solar thermal, and geothermal energy systems. So geothermal for electricity production purposes will no longer qualify for properties that begin construction after June 16th of 2025 under Section 48. However, we saw geothermal utility be stay under Section 48E, as well as geothermal heat pumps actually went unscathed and are available as a technology through 2035, remaining under the Section 48. So I know there's a lot of complexities there. Definitely reach out if you have any questions regarding technology capability and code sections, as the rules are different depending on the property type and the code section.
All right. So before we get into the bonus credits, two things to note. This is one of the reasons why we love geothermal heat pumps. If you are installing geothermal heat pumps or working with tax-exempt entities or for-profit entities that are considering installing geothermal heat pumps, have them reach out to us today so we can walk them through the process. Also, just a clarification note, we've discussed construction start date in other webinars, but I just want to confirm it's the same safe harbor and physical work test that we've discussed previously. Is that correct, Andrew?
Yes, that is correct. And the safe harbor it comes in two different forms: either the 5% rule, where you're spending 5% on your project to substantiate the start of construction, or you're starting physical work of a significant nature, which I know you've covered in depth in prior webinars here. And both of those two safe harbors need to maintain a continuous construction program, meaning there shouldn't be any stalls or delays after doing that one piece that the IRS is requiring you.
Yeah, if you guys have questions about construction start date, hugely important. There are some nuances. Please reach out to a professional, just like Leyton. But for now, let's get into the bonus credit. So I think the next slide is really going to lay out for everybody what these credits are actually capable of producing. So without further ado, Andrew, you want to kind of walk us through, this is a great graphical visual representation of how do you get to 70%, but we're going to double click on domestic content, energy community, and low income community here in the next slide. So if you could just briefly give us an overview of how this big puzzle works.
Right. So what you're seeing in blue there is going to be what we call the base credit. Your base credit is going to start at 6%. Depending on if you meet the prevailing wage and apprenticeship requirements or they're waived, it automatically boosts to 30%. Then in orange there, you're going to see the different bonus adders depending on location, depending on activity, or through requirements for such as domestic supply. So when that domestic content can give you an additional 10, being an energy community bonus can give you an additional 10, and then low income community bonus is going to be the next four, where you can get either 10% for being in a low income community bonus or tribal land, or if you're taking on a project that serves the by way of helping individuals in poverty, so the low income residential project or the economic benefit project, you can receive an additional 20%. So theoretically, you could get a 70% tax credit. Though unlikely to get the full 70%, we have seen instances where people get either 50 or 60% of these tax credits. So it's very substantial.
Now let's briefly talk about a complex topic. So we're going to kind of quickly discuss prevailing wage and apprenticeship. And we have other resources that we've put together for prevailing wage and apprenticeship. That's why we're not going to spend too much time talking about it. But it is an important part of this incentive. So Andrew, please take it away.
Right. So the prevailing wage requirements here, set by the Department of Labor. Again, to Cedric's point, not going to spend too much time here, but you need to, all workers on a project need to be paid above the prevailing wage rate. Also, there is an apprenticeship requirement part where this includes, a ratio of apprenticeship to journeyman. The percentages increase after 2023, and there are heavy penalties here. So one thing that I would say the first thing that you should look for is when scoping your project is the size and when construction started. Because if your project is under 1 megawatt in electricity or thermal equivalents, which I believe is 284 tons, then you are exempt from this. If your project started construction prior to January 29th of 2023, regardless of if it's placed in service 2, 3, 4 years later, then you would still be exempt from that requirement.
All right. Now let's talk about the domestic content. There were some changes from the one big beautiful bill. So take it away with some of those changes and where we are now.
Right. So two rules here, one that's a bright line and one that is based on what you can collect. So for the domestic content steel and iron, any structural components in your energy project must be 100% US made. For the second rule, all the other items, which are going to be classified under the domestic manufactured product components, is what the rule essentially is from a direct cost standpoint within an entire manufactured product, 40% of the material must be mined, manufactured, or produced within the United States. So depending on the components and where they're sourced from is going to ultimately determine if you qualify for this. Now, that threshold was 40 at the beginning of the Inflation Reduction Act, and that is going to last till June 16th of 2025. It has now essentially been hiked to 45% for the rest of the year 2025, 50 for 2026, and 55 from here on out after tax year 2027.
Got it. Seems simple enough at face value. Quick answer to this question because we are short on time, but what's the best way to make sure that if I am going to commission a project for solar, wind, whatever the technology may be, that this domestic steel and iron, that this bonus adder can be met? Would it be, write it in the scope of work at the very beginning or halfway through the project? When does this need to be determined?
Right. Halfway through the project is too late, and definitely toward the end. I have almost never seen substantiation be done retroactively. It needs to be part of the project requirements. And I would harp on that for the RFQ and the RFP phase to get that in and start looking at contractors and vendors that can supply this information. Because it is a matter of 10%, which could mean hundreds of thousands of dollars depending on the project, right? So definitely something to have in during project planning phase.
Perfect. Now, as far as we talked about the domestic content, so we're going to go to another bonus credit, which I believe this one was also 10%, but this is the energy community bonus credit. Walk us through this, please.
Correct. So this is the energy community bonus credit. There's 3 different ways that you can qualify here. It's not based on activity, but more so location, right? So the most popular one, and the DOE has a website for this, but if you are in an MSA or a non-MSA, which means you're in a fossil fuel or tax revenue area with the average employment or unemployment rate being larger than the average, then you'd be in one of these areas, and it's by census tract. So there's a map for that to determine that if you land in one of these areas, you get 10%. So there's some rules on where, depending on when you started construction, you might want to be in an energy community at the start of construction, as well as when placed in service. But again, reach out if you have any questions on if you qualify for this additional 10%. The coal closure category, very similar. If you're in a census tract where there was a coal closure for a unit retired after 2009, you'd qualify, as well as the adjoining census tracts. So lastly, the brownfield one, this is one where if there was some type of chemical or oil spill in an area that led to a remedy or a phase 1 or phase 2 assessment with the EPA that was ultimately remedied sometime in the past, building energy, clean energy items or geothermal heat pumps or what have you could get you an additional 10% in or near that facility.
All right, so I think this is the last bonus outer that we're going into, and then we'll get into kind of the closing parts of this, which are we're going to give you a case study, and we're going to talk about best practices and some pitfalls that we see. So low-income community bonus, 10 to 20%. How do we get that?
Right. So the first two are going to be location based, or really, I should say, all of them require an application from the IRS and the DOE. Another requirement is that your project cannot yet be placed in service. However, you have to have a clear intent that you are placing this electricity producing equipment into service. So, quick example: if you have undergone a contract with a solar installer, you have an executed agreement. It's going to be commissioned 6 or 7 months from now. That's when you expect to have a permission to operate. And you're within the timeline from January 1st, 2025 to August 1st of 2025. You can go on this portal and create an application depending on the type of category you're in. So first one or the first two are going to be based on whether you're in a low-income community, and the rules are right there on the screen, as well as an Indian on Indian land. 3 and 4 are going to be based on programs. So if you are renting out buildings or undergoing a construction, and it is qualifying for, say, LIHTC or some other covered federal HUD housing program, you could get an application ready to try to receive 20%, and it's on an allocation basis as well. So this is something that you're going to have to watch to make sure that after you provide this information, you receive an allocation or not. And the fourth one is going to be the economic benefit project adder. This a requirement here is that 50% of the financial benefits of the electricity produced have to be provided to households that make less than 200% of the poverty line, or households that make less than 50% of the average median gross income. So we help clients figure out their financial benefit statements and arrangements in order to substantiate that the activity that they're doing on site actually does qualify, pertain to the DOE IRS code and regulations, in order to heighten their chances of getting that 20% bonus adder.
It's a big bonus adder. All right, let's do a case study. What do you think? Walk us through this. I believe this was one of the school. Yeah, this is the school district in Illinois that we worked with. Andrew, walk us through this. What are we looking at?
I believe this was one where it was placed in service sometime in 2024, started construction prior to January 29th of 2023. So it was a geothermal heat pump project. And after segregation, the total cost of the actual heat pump project itself was about $2.1 million. They qualified for the base credit because they had the apprenticeship and prevailing wage requirement waived due to their beginning of construction date. They were also in an energy community. We're seeing a lot of areas in Illinois that are in an energy community. The total for that tax credit was $848,000. However, the project was financed with tax-exempt bonds in the full amount of the $2.1 million. Therefore, a 15% credit reduction was made, and that is per the guidelines that the IRS set for the 6417 entities. So the final refund on this was $720,000.
Wow. And so $721,000 is what they received in the form of a refund check for their installation of geothermal heat pumps.
Absolutely. About 4 months after filing, they were able to receive this.
That's strong. That's a very big number. Okay, so how should we plan for this if you're a tax exempt entity? What are some considerations? That's what we'll get into next.
Okay, so project planning, this is going to be, again, the most important part. This is where you're identifying your technology that is going to pertain to the tax credit. And from there, you're going to want to also analyze what if you're in an energy community, so location based, if you're in a low income community, and it's say a solar project or another electricity producing project, you're going to want to understand what you need to do for the application there. And then domestic content is going to be, again, something that you're going to want to put in requirements, or at least assess the feasibility of domestic content for your energy property makes sense. Now, within project construction, this is going to be a very key component for the low income community bonus. If you qualify, you're going to want to make sure that you're getting all of the proper documentation and the application sent over. The IRS wait time on that is about 4 to 8 weeks. And at that point, you're testing that the system is not yet placed into service. If it's placed into service prior to the allocation being received, you would be disallowed from getting that 10 or 20%. So just another thing to be aware of and to watch out for when you're in a low income community bonus. Now, project completion, this is where you would, at the end of project completion, you're getting that certificate of occupancy, permission to operate, or what have you. That is the information that you would need for placed in service. This is what locks you into eligibility within that given time frame or tax year. So after placed in service, you're then able to do your IRS registration. That gives you a registration number that you are going to ultimately use on your return. So moving on to return for tax filing, there's 3 important forms here. The purpose of the first form, and for purposes of 48 and 48E, the source credit form is going to be a form 3468. This is going to be all of your project information that summarizes your costs, your cost segregation efforts, as well as your any additional bonus adders. This is where your registration number would go as an applicable entity, as well as a control number if you were able to get an allocation through the low income community bonus. And this number funnels into the second form, which is a 3800. This is the general business credit form, and it's essentially, for purposes of nonprofit, a flow through mechanism to get the tax credit amount over to the general form for filing, which is going to be a 990 or a 990T in most cases. And with all that wrapped in together into a filing, you submit that over to the IRS and await the processing. And typically what we're seeing is after a deadline, let's say 5/15 for a calendar year study, 5/15 of 2025, you would start to begin to hear back about 3 months after.
Yeah, so we are running a little bit short on time here, Andrew. So we've discussed most of these, but let's briefly walk them through some common pitfalls. And I think, yeah, let's spend a few minutes talking about this. If we go over 30 seconds, that's fine.
Right. So again, we've already talked through the missing deadlines and missing registration. Only note on registration is that the IRS can take up to 120 days. We've never seen 120, but they can take up to 120 days for registration. So as soon as your property is placed in service, try to get a registration number so filing is smooth. Don't assume this is an automatic payment. Again, the timeline is pushed out, and this is a rebate-like structure. So allow for months after to receive the cash. There could be a myriad of errors in calculations, forms, from anywhere from the cost seg work to substantiating any of the bonus adders as well. Highly recommend a tax professional there. Remember the sources of funds you're using, whether they're tax exempt or grants. So if it does seem like a lot of free money from multiple sources, whether it's state or federal, remember that all those kind of need to be looked at under one lens when claiming an ITC. Sourcing and labor requirements, again, emphasized heavily in the RFQ and RFP phase there. Pay attention to those. And recapture and compliance risk. I think the last 5 points that I've touched on here kind of flow into either disallowance of a credit or in cases where your energy property isn't in service for 5 years, you would need to claw back a portion of that property. So we also have best practices here for a smooth direct pay experience. So start planning early, get a tax advisor involved, if you will, keep thorough documentation. If you're working with the taxpayer on the with a specialty tax preparer consultant on the onset of the project, they'll help you out through the with the documentation. Needs to be thorough. Double check that IRS registration info. There's times where they're asking for more information. It can hold up the process. Fill out those forms definitely carefully due to all the different errors that can happen from cost seg all the way to the filing of the forms, and then budget for that delay. We've seen within for construction projects that in ideation phase all the way to receiving payment, it'd be over 3 or even 4 years. So make sure that you realize that it is a rebate-like structure, and you can get that payment months, not months after placing service, but months after filing is taking place.
Nice. All right. Rounding up here towards the end, kind of talk through our process. I don't think it's anything spectacularly difficult, right? In fact, I think it's quite the opposite. We make it easy on the taxpayer. If you want to just briefly walk through it, it's very much in line with the pitfalls that you saw in the previous slide. But briefly walk us through kind of our process so folks understand what would look like. Sorry.
This is a process where we'll essentially shepherd you through the process all the way from our letter of engagement to kickoff, where we figure out where we're at in the timeline and see how we can best help to maximize your credit while staying within the letter of the law. We'll gather all that information and act accordingly on what we believe we can claim. During that feasibility, that is where we're essentially locking in whether domestic content is going to be eligible or not, what bonus adders are going to be applicable. And then moving into the qualitative and quantitative analysis is where everything essentially comes together, whether that be costing methodology, as well as the substantiation for bonuses and any other information, any lagging items that's meant to put this entire credit together. We then will either work with your tax preparers or partners in order to get the tax filing done for you. And then on the back end, we are creating a hardbound deliverable that memorializes all of these activities that take place. And also that could be used for the event of an unlikely audit.
All right, that basically, I think that sums up the webinar today. Just a reminder of some of the services we offer here at Leyton, international tax consulting company, leading provider for R&D globally. For commercial real estate folks, cost segregation is back to 100% bonus depreciation is huge. And then we also do state and local taxes as well. So I do think there was a question that we want to make sure we answer for Jay Holiday. He asked, are there any post-project compliance? I'm having trouble reading this.
Are there any post-project compliance obligations for nonprofits that receive ITC direct payments? So depends on what you mean by post-project. I think the first one is that if you're getting the low-income community bonus for a solar or a wind installation, there's post-placement service requirements attesting that the project's true or complete. They also ask for some sizing, capacity data, and this is before you would file. And post requirements would look like any recapture requirements. So you would need to report that your property is not in service anymore if it goes out or is otherwise abandoned prior to 5 years from the time placed in service. There's a 20% clawback in the amount of credit for however many years under 5 that you would have gotten the tax credit for, if that makes sense.
20% per year?
20% per year. So if you had $100,000 credit and in year 4, it otherwise ceased to be energy property, you'd only get back $80,000.
Got it.
Or you'd have to pay back $20,000.
see. I see. Complex stuff. You're making it sound easy, Andrew. That's why we love Andrew for ITC. He makes the complex stuff seem pretty easy. Are there any other questions before we part ways? Okay. All right. Well, I appreciate everybody's time today. The moral of the story here is get with your tax professional if you are interested in adding these technologies onto your building or doing one of these types of projects. But thank you for your time.
Thank you all. Have a good one.